Okay, good afternoon, everybody. And we are live. And today we have Sarah Dawson and Frank here. Um, and we have bookkeeper and CPAs and why you need both. We are Bang Broker Alliance Networking Group. And for those of you joining us for the first time, we are a group of agents it's a worldwide network of agents that we get together for the purpose of building relationships and getting to know each other so that we can better refer each other. So, without further ado, we are going to go to Miss Sarah. Miss
Hi,
Sarah, how are
everybody.
you?
I'm good. Nice to see everybody and glad to be here. Thank you for inviting us.
Thank you, Sarah. Sarah, can you tell us a little bit about who is Sarah?
Well, I've been a bookkeeper my entire adult life. It's something that I really enjoy doing. But what I've been doing the last year or so is helping to bring knowledge about lakeside accounting to the world because that's very special. It's not your regular bookkeeping firm because we've got a great founder. And so I'm really happy to be here to tell you about lakeside accounting.
Great. And Kevin, Mr. CPA, as I call him. Tell us a little bit about who's Kevin. And Sarah, if we could stop sharing so that we can see Kevin.
Oh, yeah. There you go. There
Hey
you are.
everyone, I'm Kevin Franks. I run KMF CPA. I started my career fresh out of college in public accounting. Went in to do some corporate work for quite a while. Got to sit on the side with the controllers and the CFOs. My final position in corporate world was the CFO for an automotive group. I wanted to help individuals and business owners take advantage of tax law, so I retired out of that profession and opened my own CPA firm where we look at everyone's individual tax strategies along with their financial goals and build them the most beneficial tax structure that follows all the rules and make sure that they stay compliant with IRS guidelines and their state guidelines, depending on the states that they are in. I file tax prep, but my specialty is building tax strategy with the business owners for long-term planning. I'm looking
So
forward to
that
talking
sounds
to the big groups.
interesting.
Yep, go
That
ahead,
that
Mr.
sounds interesting. Building strategies. We're all about strategies. And number one, we want to thank you both because we know that this is your busiest season and you're taking time to speak to our bank members and to give them a little bit about the insights or the in and outs about filing your tax returns. So as you know, our audience, most of our audience are realtors, which in turn are business owners. We have a bookkeeper and we have a CPA. Why do we need both?
Well,
Sarah, you want to take that question?
yes,
Or,
I'm
or
ready.
just give us the bookkeeper side. Why do we need Super Sarah?
You need Super Lakeside. And we do a lot of things that get you ready for the CPA. And I have a little graphic here that kind of talks about what we do that's different than what you yourself, the business owner, does and what the CPA does. And some of the artful things that we do is design a really excellent chart of accounts so that it's useful to you and it's good for your CPA. It's efficient for them, but it gives you the information that you need. We categorize your transactions, we prepare monthly reports, and that's really important because you need to know how your business is doing. We work with integrations. So if you're a developer and you've got a project management tool and you want it to tie in and collect your receipts and all that kind of stuff, we are there to make sure that that's working and working well and your reports are more accurate than if it's not working well. For people who are flipping properties, we are adding all of the things that you spend. Like if you buy a property and you're going to develop it a little bit, you're going to have expenses that goes to your assets until it's time to sell. This will increase your equity. It'll look better on your balance sheet. So if you need to borrow more money or get more investors, your balance sheet's going to be looking better than if you say, oh, I spent all this money and this is all I got in my bank account. And then when you sell the house, then we know what all the expenses are, and we tell Kevin here's how much the expenses were, and now your tax liability is less than it would have been because you've got all these cost of goods sold. For realtors, you want to know if the little bit that you put in yourself, maybe a cleaning fee, some advertising, some light switches or whatever, is going to make that house just a little better. Are you getting good return on that investment? And if you're not doing the monthly or regular, maybe even quarterly reporting, you're not going to know that. And landlords, you know, you might have more than one property and you're going to have a Schedule E, and you've got to keep track of property A, property B, and so on. And you've got to know which income is for which property and which expense is for which property. And we keep track of that. If you're under the one umbrella, we use classes in QuickBooks. There's other strategies, but this is something that's really important. You also may have multiple properties under different entities. So you might have a tax ID for each different entity, in which case you need different QuickBooks or different general ledger accounts, depending on the software you use. And you might be saying, well, this property is actually a pass-through for this entity. So now we have to figure out how to make sure that all the balances match when money goes from one entity to another, because that happens. And so there's journal entries that have to be done. And developers, we help you keep track of those expenses as you're developing a property, which is so important because at the time of escrow, you've got to be able to report that so that you're not paying out to the investors that you have more than you should. That will cost you a lot of money. And you'll be at risk of scrambling at the end, trying to figure out what it is, and then maybe not reporting accurately. We give all that information to the CPA so that it's ready. And Heather Moreland is our founder. She started Lakeside 3 years ago, but after getting an MBA and working in corporate manufacturing, she's very bright. She worked on her father's books when she was a kid in high school, and he was in real estate. So she has a lot of experience with real estate and knows her stuff. And we have a lot of clients that do this stuff. And so you have an expert team. We've got a team who does cleanup. So if you haven't filed your tax return in a while, we can do that. We can clean you up a couple years back. Help it get ready to send it over to Kevin so he can file your taxes. And then we have a monthly maintenance team that will take care of your books on an ongoing flat rate basis. And then Heather herself does coaching for smaller people, smaller entities who can kind of DIY it, but have questions or need help with their QuickBooks or Xero or whatever your platform is. And so that's us. And so we're getting you ready for the year. And giving you over to Kevin.
So thank you, Sarah. Sarah, if you can put your information on the chat, and I'm going to come back to ask you some questions as well.
Okay.
But I'm going to go to Kevin now. And with all of this stuff that Sarah just mentioned, oh my God, we have to put all of this together. And it seems that Sarah has it all worked out. She knows in every box that needs a check mark, and she knows every receipt where it goes, and she's organizing it for us. Now, what does Kevin do? What is it that now happens behind the scenes?
So as your CPA, once we receive that data, a lot of clients try to bring cut the bookkeeper out and not have that data ready or accessible. So at that point in time, we are building what she has to build the tax return.
Which in turn is going to cost them more.
Cost them more. CPAs have higher billing rates than bookkeepers typically. As such, you want to take advantage of running your business most cost-effective manner. You want a bookkeeper to prepare your monthly reports, prepare your balance sheet, prepare your P&L, and then provide it to your CPA. As the CPA, I'm taking those prepared reports and then filing the tax forms associated with that, whether that's a Schedule C because you're a solo individual that's just taking commissions, or whether you've gone in and created a S election and have an S corporation or a partnership with a 1065.
Let me ask you something, and I know you're actually I'm interrupting you, but that's something that a lot of realtors are always juggling. And I know the answer might not be a straight answer, but that's okay. That's what we're here for today. So as a realtor, should I have a separate tax entity or a separate, or should I just do it under my social security? Are there benefits from that? Explain that a little bit to us.
Absolutely. It's where I was headed. So whenever we've got a developer in that situation, that's a different strategy and a different situation than a commission-based agent. And that's also a different situation than an investment-based agent. There's, of
But
course,
not
all
all real estate agents are the same.
not all real estate agents are the same,
You
just
can't
like
fit
not
us
all
all in
accountants.
one little box and say, okay, this is what we do and we're done.
If you could do the same for accountants and bookkeepers, and that's just not true. CPAs have a different role than a bookkeeper. We're both accountants. So just like you guys are all real estate agents, each one of you have a separate little niche, and for that, it matters. If you are a commission-based agent and you're a high-performing, high-income earner, you should most likely look into creating an S corporation for yourself and your sales, have that run into your S corporation where you pay yourself a W-2. And you need to make sure you're paying yourself reasonable compensation with an S election. If you're not paying reasonable compensation, that's an IRS audit red flag. They've actually come out and stated that they plan to uh, audit that going forward, moving with S elections. That a lot of people have taken an unfair advantage with using their S corporation, and as they audit them moving forward, they will be asking to examine how you determined your reasonable compensation. And if you don't have a written economical method, they will be denying that compensation plan.
So
Um,
remember, I'm a sales agent. I'm a real estate agent, and you're a CPA. So we're talking different languages here. So in my terms, in many cases, or in most cases, it would save the real estate agent money to be an S corporation or some sort of legal entity versus just being Jeanette Vidal with my social security number and moving forward.
Absolutely. So self-employment income, if you're a Schedule C, just doing it as yourself with your social security number, is subject to self-employment income tax. There is a maximum cap, but the Medicare portion of that is never capped. Your self-employment tax is 15.3%. If you're employed by someone else, that is paid by half of it's paid by the employer and half is paid by the employee. But as a business owner, when you own your real estate agent business, the profits in the years where you have banner years are not subject to that same employment. I also have a third party that does a reasonable comp study that allows us to go out and get exactly what the IRS wants for reasonable comp. And that has historically been lower than what most people think that they want to pay themselves, because as business owners, we know our value and we know what we bring to the table. And we sometimes have egos about that, the market doesn't necessarily support, or the market shows that we can obtain a cheaper labor rate in some methods.
So,
Having
so in
that
some
information,
cases, you are like a real estate agent. You take the emotions out of that CPA, of that accounting, and you just look for our best interest and
absolutely.
take our ego out and let's get down to the numbers and see where we can save you more money.
That's exactly what my role is. My role is
And,
to minimize your tax liability in whatever methodology is legal but takes advantage of your personal situation.
and don't forget about the qualified business income deduction. That's a big one for pass-through entities. That will save you on that 15% for sure.
It does. So the qualified business income deduction, it is allowed on a Schedule C, but it's also allowed in your S corps or your partnerships. It has a large piece to the puzzle. A lot of people say, can I not just be a DIYer and do my own tax return? Well, that's like me saying I can sell my own house. I'm not a real estate
Sure you
agent.
can, but I'll negotiate a lot better for you.
You will. And the IRS doesn't track how many credits are misapplied or not taken when they should be, because they just don't have that ability. The one credit they do monitor is what's called the earned income credit, and they know that 1 out of 5 miss it. So they believe 20% of taxpayers are missing the earned income credit while they're entitled to it.
So
So
they're
while I
leaving, we're
worked in,
leaving money on the table.
most taxpayers are leaving money on the table.
So what are things that for our audience that is listening to us now, what are things that typically people miss that they forget. And I know that we're going on the fly here, because for all of you that don't know this, but we're just having a conversation and talking tax and CPA and bookkeeper all at once. And there's nothing prepped here. So what are things that people mostly miss on these that they say, oh gosh, or when you look at people who had filed and you look at their back taxes and you're like, wow, I could have done this and I could have saved them here.
So Sarah's point about QBI, qualified business income deduction, that is
What
missed a
is
lot.
that? And let's start off by giving us information. What is a QBI?
So under the tax code, in 2017, they changed the rules and said that if you have a business that generates net income, you are allowed to take a deduction against that income just for no other purpose than you were profitable and you made money. And so it's a 20% deduction. There are rules and caveats, and you have to have wages or self-employment income. And it's a it's a complicated tax calculation that a DIYer may miss pretty easily. If
And don't you have to have separate accounting books if you want to take your QBI if you're using a Schedule C? You really need to have your business set up, and any bookkeeper will tell you want to do that anyway, separate accounts for your business from your personal.
Absolutely. And you want separate accounts, you want separate books. If you have separate books, the IRS, I'm switching gears a little bit here, but separate books allows a higher depreciation and expense threshold policy. So if you're producing financials with your bookkeeper, the IRS automatically gives you more leeway. If you don't have that, then your capitalization threshold policy, to explain that a little more, when you buy something for your business, if you have dedicated financials, I forget the exact amount right now going off the fly. I have to keep those numbers change every year. So I have a little table that I pull up on my screen and look at. But if I recall correctly, it's a sizable difference between someone who doesn't have a set of financials and someone who does. The IRS is placing weight on producing financials. Your bankers, whenever you're trying to get credit lines and different other retail install or products based off of your needs as a real estate agent, they're looking for financials as well as tax returns. And then they're going to go check with the IRS to make sure that those tax returns were actually filed and all that matches. So other things that typically get missed are how many of individuals have children that help them with their technology. Are you paying your kids if they're truly helping in the business role? That's a pretty big
So you mean our
item
kids for
sitting out there.
helping us on TikTok, they
The
qualify?
business can pay them. Yes, absolutely, they qualify. So if we can take advantage of that, that makes sense. At the same time, you don't want to. Plenty of parents live in separate states from their children. You don't want to pay that child if they're not helping in the business. You got to keep it legal and keep it right. The IRS is all about ordinary, necessary, and making sure that you deduct ordinary and necessary expenses in your business. Well, if the child is not in the same state as you, it's probably kind of hard for them to help. Now, of course, there's a remote worker exclusion that we can talk about, but other items that typically get missed are your cell phone bills. Some people expense them, some people don't. Depends on, do you have a written policy in place about your business use? Uh, is it a necessary and ordinary expense in the operation of your business? Are you supporting your kids' little league or community sponsorships? Are you actually receiving advertising exposure for that? Is there a benefit to that? Is it documented? CPAs love documentation trails created by bookkeepers, just point blank. It allows
So
us to
let's
turn
drill
around
a
and
little bit
focus.
into that sponsorship versus advertising.
Absolutely. So a lot of people want to push charitable contributions. Charitable contributions have a different tax set of rules behind them than advertising. If you are advertising, you're putting your name out there, your brand out there, you're looking for a return on your investment. You're looking to make business connections where, in real estate, if you're selling houses, you want that next time they go to sell their house, buy a house, you want them to pick up the phone and call you. It's not going to be an immediate return. So, are you somehow measuring the return that you're getting for getting your name out there on a banner? How are they remembering to call you as their real estate agent instead of the agent down the street?
So
So,
what I'm understanding is it is probably better, and correct me if I'm wrong, I could be totally off track. It is probably better to be an advertisement versus a sponsorship,
yes,
because the
absolutely.
donation or sponsorship does not make you
So it
business, or
depends on
does not.
your right. It doesn't make you business, and it gets deducted at a different way. So if it's a Schedule C or you're being your sole individual, it moves that deduction to your Schedule A. Well, with the new higher standard deduction rates, not everyone's taking advantage of a Schedule A deduction anymore.
Mhm.
If it's flowing
So the
through from an
donation
S,
might just go and
That's confused.
not have
It'll
an
just, the
impact.
donation doesn't even go on your business deductions. Yeah,
nope.
So we got to make sure that these donations are, which most of the time they are advertisement, because I mean, yes, we do it from the bottom of our heart. We do it, but we really also do it for business purposes. So it is advertisement. So if you all are listening to that, advertisement versus donation will make a difference depending on how you.
absolutely.
What
Yep.
else do you think they miss?
Well,
Um,
can I say something? Or is that, I mean,
Jump
Of
in.
course you
I have
can.
an
This is an
idea
open
on that. And I know,
conversation.
Kevin, you're so amazing. I was just thinking about just, the type of entity you are. I've seen a lot of people miss whether or not they should be paying themselves payroll, whether they shouldn't, what type of entity they are. And I wanted to just talk about the commingling because if you have set up yourself as an LLC, that's limited liability, and there are protections there for you as a limited liability or as an S-Corp. And if you commingle your personal and your business bank accounts and credit cards, you are eliminating they call it the veil of
Corporate
security,
veil.
the corporate veil. You're eliminating that, and causing yourself more open to be liable for anything that could happen in your business. It doesn't separate that. So they can come after you personally. So aside from the fact that it will take your bookkeeper so much more time to do your books if you're commingling, it's just better practice to have a credit card for your business, have a bank account for your business, and the same thing for your personal, and do not use the same for each.
Absolutely.
Wow. That is great advice, Sarah. Let me see, what else can we ask? I mean, what
What
volunteer information would a CPA give us? Because I'm kind of out of questions here, because you guys are way over here.
So one of the things that normally comes up whenever I look at a new client's books, unfortunately it comes out, is that they didn't match their payroll with their entity structure. If you're running a single member LLC or a single member limited liability company, you shouldn't be paying yourself payroll through a payroll provider because that is subject to self-employment income, as that's a disregarded entity for tax purposes. Whereas for an S corporation, you should be paying yourself payroll, reasonable compensation. If you're a partnership, that flows through as a guaranteed payment on your K1, you shouldn't be taking payroll. Unfortunately, a lot of times what we find is because you pay your employees, even as the business owner, you just put yourself in the payroll group and you're in that partnership or you're in that single member LLC. That's not proper form and it's not proper issues. It happens a lot, but it's not, it can create a lot of audit issues if the IRS ever comes knocking.
And I love that, because one of the things that I've always said is, I'm not going to say I'd rather pay more, but I've said this. I'd rather pay more than tip an audit, because that just involves so much time, money, and effort that definitely none of us have time for that. So we want to make sure that we have a great tax strategy and we pay as least as possible, but we don't want a red flag because sometimes paying less might end up paying more in an audit.
A lot
Mm.
of times, especially when you're picking your CPA and your bookkeeping and your advisors in that field, making sure they have the knowledge base and the experience to choose your strategy wisely. I unfortunately reviewed plenty of returns where the tax preparer didn't fill it out properly. That's an IRS, whether they want to come audit it and they have the support to audit it. The IRS has come out in recent years and kind of said, we look at taxpayers and does it make sense for us to audit them as a business standpoint? Are we going to recover additional taxes for the dollars that we have to spend on the audit? Because while we as the taxpayer have to spend all that time getting our books and our records and our paperwork together for an IRS audit, they have to spend the exact same equal man hours on the other side coming in to prepare the audit. And then they're graded based off of how they perform on those audits. So making sure that all of your forms are in line and all of your tax preparation is in line and that you've identified the right structures and strategies for your business and that you followed them and you dotted your I's and you crossed your T's is very important. And making sure that you get your 1099s completed and making sure that you're paying using the right terms. And it all matters.
And one big dotting your I's and T's is on your meal. There's been changes in 2026 about what meals you can deduct. So if you go to a cafe to work and you're drinking coffee while you're working by yourself, that is not deductible anymore. And the only meals that are deductible are ones where you're meeting with potential clients or, and so you need to write down who you had that meal with and you need to keep that receipt. And travel meals, of course. And when you travel, you need to write down, where did I travel? Why did I travel? Who was I meeting? Those are important records to keep, more than keeping your, $35 office supply receipt, because those things are just, suspect. And you kind of have to attest that you're being right with your meals, right? And office meals, like if you have an office, you can't buy your employees meals anymore, or you can, but it's not deductible.
Right.
So you're welcome to, but it's not deductible.
So
It's still
how
a fine
what
thing to
would be
do for
an
your employees.
example? What would be an example of a meal that would be deductible if you're going to buy your employee's meal? Maybe a client lunch that you bring a
Yes,
client to speak to your employees.
yes. But if they were working late or you were having a meeting, the snacks that you buy for that meeting or in the coffee or break room are not deductible.
That's a
So
pretty big tax law change that came out. Yeah.
let me ask you, Sarah, something. And I know we've joked about this before, but if you were looking for a bookkeeper, what would be the characteristics that you would be looking for? And of course, you're going to say, "Hey, Lakeside Accounting," of course. But let's kind of get some guidance here, and we're going to share
Mhm.
your information. But if you were just Sarah, didn't know of Lakeside Accounting, what would be the traits, and what questions would you be asking that bookkeeper that you're going to hire?
Well, there's a few things. I would, in the QuickBooks world, there's things called pro advisors, and those are folks that, they have to pass a certification in order to, use QuickBooks as a tool and to also know what's the best, that you can advise your clients about what's the best version to use. So that's a good one to have. What kind of credentials they have or work history they have. There are no requirements. Anybody can raise their hand and say they want to be a bookkeeper. There's no I mean, to be a CPA, you have to go to school. You have to have one of those gorgeous plaques on the back of your wall like Kevin has. I don't need any of those, right? So you
And
definitely,
that's what's so scary. That's why I'm asking you,
yeah.
because since anyone could say I'm a bookkeeper,
Mhm.
we want to hone in on those questions and see what their experience is
Mhm.
and what qualifications. They might not be required by law, but I
Mhm.
want to know that this is not just someone that
Mhm.
plugged my stuff in ChatGPT and said, "Hey, go
Right.
ahead and record my bookkeeping."
Right. I would have them look at my last tax return. And if I have a current QuickBooks file, I would have them compare what's in my QuickBooks balance sheet to what's on my tax return balance sheet if I have a balance sheet. Some tax returns don't have it. I would ask them questions about, well, this is the kind of entity I am. What are the implications of that? Just little things like that will tell you whether they know anything about anything, because I've seen a lot of bookkeepers who have gone along and done payroll for someone who's not an S-Corp or whatever. They were just a sole proprietor LLC type pass-through entity. And they didn't say anything to that person for years and years. You shouldn't be paying yourself payroll. So these are the kinds of things that bookkeepers can help if they know their stuff. So I would ask sort of, who they know and how they work with the CPA, because a lot of bookkeepers are just not following the balance sheet. And that's so important with understanding where a company is. You can look at a balance sheet and in 3 minutes, if you compare that to like a tax return, know whether the books are good or not. So if the bookkeeper's not looking at the balance sheet, paying attention to that and knowing what all the lines on that are, and that it's what it is, they're not going to be solid for you. So that would be the biggest one for me, I think. Also, how long have they been doing this? I would get some references and ask their clients, like, what do they do for them and how do they do it? How organized are they? What are their systems? Just ask a lot of questions. Find out, like, are they just doing it themselves or do they have a staff? And if they have a staff, how do they keep, what are their checklists like? Because there are monthly tasks and you want to make sure that those are covered. And you can have an owner of a company, and this is what Heather does so well, is her systems and her checklists monthly, weekly, quarterly are so tight so that anybody on staff can see what needs to be done, what has been done, and there's a good communication. So if they're doing it on their own and they're doing all the work themselves, you want to make sure that, and that's kind of tough. I mean, what do we talk about, Kevin? Whether you get hit by a bus or win the lottery, are you all in on that? So
Yeah.
there's different strategies, but I think just asking a lot of questions, and I know a lot of people's eyes glaze over when it comes to this stuff, and it makes them feel nervous and have fast heart rate. But I think it's really important to just be patient, ask questions, and do your due diligence.
Do your
So
due
if I can
diligence.
jump
Well,
in,
Kevin, what about you? Yep, go ahead. You
in
were.
in picking your bookkeeper, one of the things that's very important is making sure their experience aligns with what your goals are. If I've
Mhm.
got someone who is used to working with a developer or a flipper, they are going to want to push things to the balance sheet and capitalize them. Whereas if I've got someone who works in the commission world, they're going to want to push everything to the income statement. And so if your bookkeeper is coming out and saying, I reclass your transactions from your bank statement versus I understand the difference between your income statement and your balance sheet, that's a red flag. Making sure that your bookkeeper understands the difference between the balance sheet and the income statement in your books and why those expense differences matter is key for picking your bookkeeper.
Mhm.
Thank you, Kevin. How about picking a CPA?
So picking a CPA, they need to have information on your specific role. There's generalists, and of course, there's folks that specialize in specific fields and niches. If you're working with your CPA and you're into short-term rentals, they need to understand what doing cost segregation studies for you looks like. If you're a developer or a flipper, they need to understand what your cash flow position looks like, whether how you're flipping and selling those assets. Are you doing owner financing and making those gains be deferred over that financing period? So making sure that they have the experience to put you in the right tax strategy is key. There's a lot of great CPAs out there that actually don't work in tax at all, but they try to do some tax returns, but they're specialized in management. In the accounting world, there's really four languages. There's tax, there's GAAP accounting, there's managerial or book or operator accounting, and there's not-for-profit governmental accounting. Making sure that they truly speak that tax language and not just tax because it's such a broad spectrum, but real estate tax.
Mhm.
Are they subject to the occupancy rate taxes? Are they subject to a cost segregation study? If you're going to buy it and flip it in 2 years, you probably don't want to go with a cost segregation study because all of a sudden you're going to have depreciation recapture. Knowing what all that means is your CPA's job and building that tax strategy. If they don't have the ability to have those conversations with you, they're probably not the right CPA for you as a real estate agent.
And thank you. And I know that you've often been clear that that you every time we've had a conversation or we've had a referral that you said, I don't do nonprofits. There's people that specifically do nonprofits. You have your niche and that's what you specialize in. And we appreciate that you just don't take everybody. So on that note, a lot of people say, well, you can file my own tax returns.
My answer to all the real estate agents in the room is I can sell my own house.
Exactly. So what would you say someone that does their own taxes would probably leave a lot of money on the table because they won't have the end strategy?
They won't have the end strategy. They'll miss some credits or some potential deductions along the way. They'll miss their tax strategy planning and making sure that they've put the right entity together for their plans. Unfortunately, trying to grab data off of TikTok, Chat GPT, and all these other things that I watch a lot of business owners try to do, those worked for one individual set of facts and circumstances, but they don't work for yours. Making sure that you are receiving that is a very personal conversation, and making sure that we take advantage of your personal situation is something that you and your CPA do.
And I wanted to point something out that just came to mind because, like Sarah mentioned, there's a lot of people that do bookkeeping and there's not like a certification, but there's also a lot of people that prepare taxes that are not CPA. What do you have to say about that?
So there's a lot of great tax preparers in the world. To be honest, that are CPAs. There's a lot of great agents that are enrolled agents. Just because that they're a CPA, they have a higher credential with talking to the IRS. Enrolled agents have those credentials as well. Enrolled agent has to have continuing education specific to the IRS every year. CPAs have broad accounting topics, education requirements. If they're not licensed as an enrolled agent, they can still prepare taxes other ways. But again, you're getting what you pay for. Your real estate agents, you guys understand continuing education requirements and what that means, and that it brings value to the table. So making sure that your tax preparer is credentialed matters.
Okay, so that's another thing that we need to look out for, that our tax preparer is either credentialed or a CPA. I would say preferably a CPA, but anyway, that's just my personal opinion. But anyway, I want to thank you both for dedicating time. We know that first week of April is not easy for you guys to be pulled, but anyway, you both have offered kindly to do one-on-ones. You know what a one-to-one is, and our agents are used to one-to-ones as well. So I want to thank you for volunteering that. And if you could both put your information in the chat, that would be amazing. Um, And if anybody wants to reach out to Sarah for accounting or to Kevin for CPA or to both or to one or the other, they have been amazing. I know them from a referral group that we have, a local group, and here in Nashville. But however, these are federal tax returns, so they work with everybody in the country. Actually, most of Lakeside is remote, also working from different states. So they got you covered in different states, and Kevin has you covered at a federal level to handle all your accounting. So thank you both. And to all those bank members that are watching, until next time.
Yeah. Thank you,
Thank you.
Jeanette. Thank you, Kevin. This has been great. Nice to see you
Yes,
all.
thank you both. Have a great
Thank
day.
you guys.
Bye-bye.